Hi everyone, welcome to today's webinar. This is Fawad Razakzada speaking, market analyst with Think Markets, and my colleague is also in the room, Victor. Hello, Victor.
Hello, Fawad. Happy to join.
Happy to have you join.
How does it look? What is the outlook for our favorite topic of the month?
You mean the jobs report, right?
Yeah.
For avoidance of that. Yeah.
Yeah. No, not Dogecoin and Shiba
not Dogecoin. Okay. It's going to be an interesting one. I think the Fed has already announced tapering, so the impact of the jobs report is probably going to be limited on the financial markets today. That's my feeling.
Okay.
So I think expectations are high that we will see a decent number this time around. But with the Fed already tapering QE by $15 billion a month, the expectations about interest rate hikes will only change if we see a significantly stronger or a significantly weaker number today. So anything in between, I think it's gonna be is gonna keep the current trends intact, I think. Anyway, we'll get into all of that in a minute or so. The webinar is divided into two parts. So we will first talk about some of the leading indicators that have been released throughout the week to come up with a rough idea how the jobs report might look like. And then we'll look at live charts to share some key levels and technical analysis on the markets that might be impacted on the back of the jobs report today, including, for example, gold, indices, and some dollar pairs. So before we begin,
before that,
yes.
Let's take a look at the mandatory disclaimer that we are sharing with you at this point in time. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information related to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investments based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So guys, just don't take our comments during this webinar as investment advice. It is not.
That's the key point here, but we do offer some ideas as we speak. So the webinar happens, this particular webinar happens every month on the first Friday of the month when the jobs report is released. So I've already discussed what the agenda is, so no need to repeat this. Why is the jobs report important? Well, traditionally, the jobs report has been one of the most eagerly anticipated macro events for the markets. This is because one of the Fed's mandates is to maximize employment, isn't it? So the other being obviously to keep inflation around the 2% target. Now, inflation in the US is more than double that at 5% or whatever it is at the moment. So inflation is no longer something that the Fed wants to see. In fact, it wants to see lower inflation, if anything. But the US economy has recovered strongly from the pandemic.
Not so sure anymore whether they do really want that.
Yeah, that's true as well. And the Fed has already announced it will be tapering bond purchases by $15 billion per month in November and December, with the pace of future tapering to depend on incoming data, especially wages. So there will be particular attention paid to the wage growth of this particular jobs report as investors look for second round inflation effects from higher wage demands. A headline number showing that the labor market is getting closer to the pre-pandemic levels may also bring forward the timetable for a Federal Reserve rate rise. So bear both of those factors in mind. But as I said,
yeah,
the data has to be significantly stronger for the market to change its current expectations. Now, this is what
that is correct. However, that said, I want to emphasize that two divergent payroll reports from here on out, since we already started tapering, might actually serve to accelerate or decelerate the pace of tapering. I do like that's my take from the press conference that Chair Powell shared with us the other day.
Yeah.
And yeah, any the closer the economy gets to full employment, meaning that the more people get back into the labor force, which is the crucial aspect of the data, really, that the problem is not that like the issue right now, unemployment rate is very low, but the labor force participation rate is not as high as it used to be pre-pandemic, and that
Absolutely.
needs to go back there in order for us to be able to return to rate rises and normality of some sort.
Indeed. So yeah, watch out for that particular part of the jobs report as well. We need to see further improvement in participation. But in terms of the expectations, then analysts are expecting around 425 to 455,000 jobs for October, which would be a significant rise from 194,000 we saw in September, which was a disappointing figure. The unemployment rate is expected at 4.7, and the average hourly earnings expected to print 0.4% this time compared to 0.6 the previous month. So those are the figures to watch out for. Now, what do we think the jobs report might look like? Well, we always judge our forecasts on the incoming data that had been released throughout the week. They include the ADP private sector payrolls, the employment components of the ISM, manufacturing and services PMIs, and we also look at the jobless claims data as well. And as you can see, most of them have been stronger, except the employment component of the services sector, which is the dominant sector in the US. So,
yeah, which is a surprise considering the
yeah.
fact that we've seen a record number for the services PMI, like the general services PMI.
Sure.
Wasn't that the case?
Yeah, I think that was the case. To be honest, I can't remember now how that data looked like. To be honest, I can have a very quick look at it. But if you know it from the top of your,
I think
it was, yeah, there it is. I'm looking at it on my phone. It was 66.7 compared to 61.8.
Yeah, it's a record number, and this services sector, the services sector generally depends on employment. So
right,
I'm really surprised. Like, how can you have a core number that, I mean, not a core number, but a base number that is so high, and the employment component is just slightly rising, just slightly.
It could be that the obviously when business activity picks up unexpectedly, companies will not be prepared for that, and so in the short term they might have to do with what they've got in terms of employees. But that could mean that if the pace of the expansion can be sustained for a few months, then employers will be forced to to hire more workers. So it's, in a way, that's the headline number is quite positive for the future. But insofar as this month is concerned, it doesn't look that great. It doesn't indicate that employment expanded at a rapid pace. But in any event, the market is expecting a big number. So let's see if that will be the case and how that will what that will mean for risk currencies and risk assets as a whole. Now, you'll notice that I've put up some NFP ideas. I've included the pound yen. I thought about this, and the reason I included this is because obviously the Bank of England surprised the markets yesterday by not hiking interest rates, and the pound fell across the board really sharply. But the Bank of England did say that they will hike rates in the coming months. So even if they did hike at this particular meeting, the hike would not have been significant anyway. It would have been 15 basis points or something. very small. So I think the pound is potentially oversold in the short term, and I reckon it could stage a rebound, especially against weaker currencies like the Japanese yen. So we'll talk about the pound yen
All right.
briefly in a minute or so. But generally speaking, if the NFP comes in line with expectations or above expectations, then you would expect the dollar to stay supported. And I certainly reckon
Sure.
its best bet would be against currencies where the central bank is still dovish. So the likes of the Japanese yen, Swiss franc, even the euro could be candidates to go long the dollar against those currencies.
Yeah.
If the data disappoints, especially if it's a really bad data, then I would strongly consider gold because long gold because on the back of the major central bank meetings we've had this week, bond yields have fallen, right? That kind of reduces the opportunity cost for holding gold. And the precious metal actually has done okay so far. It's been able to
It has stabilized. Let's put it
yeah.
this way.
Yeah.
It's flirting with the 1800 level. It's been doing so over the past month, to be frank. But yeah, so this, as usual, this can conclude in two ways. We have been bouncing around the 200-day moving average, which is the blue line there in the center. Any sustained break above or below it could signify a more protracted move, more protracted directional move, not this shaky range that has been roughly between 1760 and 1810.
Yeah. 1 second. Let me just.
So while Fawad comes back to us, we wanted to re-emphasize that we have these trend lines that are supporting prices around 1760-ish, 1750, between 1750 and 1760. You see that trend line that extends in an upward slope. The recent test of 1760, I suspect, which just happened a couple of days. Yeah, we have a double support level there, a double bottom. That would be price target for those of you that aim to go short on gold, provided that this report is, very bullish for the dollar. Alternatively, we have double top around 1810 and another double top around 1830, and a downward sloping trend line, which is has been going for quite a while now, almost 2 years. Yeah, is it? No,
no, it's
a year.
A year,
a year,
so a year
more than a year. So yeah, that's around 1830 as well.
Yeah.
So yeah, but in order for us to talk about those levels, we need to basically go through 1810 or 1760 first. So
yeah,
those are the more immediate levels that to look at.
Yeah, I think that gold has a good chance of a comeback here because prices have been consolidating for a long time now in a narrowing ranges. And meanwhile, I was about to share some yields charts. Yields have started to go down a little bit in recent days in the US.
Yeah, true.
And elsewhere as well. In Germany, yields have gone down. In the UK, more significantly because of the Bank of England surprise inaction, yields have started to go down, which is positive for gold, isn't it? Because gold is a non-interest bearing commodity. So whenever yields go down, gold tends to go up. And focusing purely on the technical side of gold, the fact that it's been consolidating for such a long time, and the fact that it didn't drop big in the aftermath of the Federal Reserve's decision, that to me suggests that the downside risks may have been fully priced in. And if that's the case, then there's only one way it could go, right?
Well, yeah, I want to argue about that.
Sure.
Not that I'm not that I don't agree with you fully,
Yeah.
but there is if we look at, first of all, if you could switch over to the 4-hour chart, which I know is only my favorite, nobody else uses that. But yeah, we had
1 second. 4 hours. There you go.
Yeah, we had several attempts to stick above 1800. So for me, that is the crucial level that is going to tell us where we're headed next.
Yeah.
Every attempt to break through has been met by renewed selling pressure, and apparently it's something that of a line in the sand for gold traders right now. So
that's a very important level, isn't it?
18.
Let me just get the precise level. That's the short term.
So a daily close above 1800 is what I'm looking at in order to attempt to go long.
Okay.
That
gives you some confirmation. Likewise, I was going to talk about silver, but just going back to the weekly to conclude on gold. Just remember that the long-term trend has been undoubtedly bullish on gold, right? Since the last several years. And what we've seen since last August is merely a consolidation, if anything, because price of gold hasn't even fallen below the 38.2 Fibonacci retrace, which is a shallow retracement level compared to the deeper ones here. So this could just be a very long-term continuation pattern, like a bull flag, for example. Just bear that in mind whenever you trade gold, because such continuation patterns, when price eventually breaks out because of the length of consolidation, we will see a massive move. And I reckon that might be the case once again for gold, that it's gearing up for a big breakout. I think the macro backdrop is still quite bullish on gold. If you think about where cryptocurrencies and especially these meme coins have gone, people throwing money at everything, right? Why not at gold? At least gold is something tangible. It's got many users. It's a hedge against inflation and whatnot. It's got I reckon that against compared to lots of cryptocurrencies, obviously exceptions being Bitcoin and a few other ones, gold is still gold, and for that reason,
Shiba Inu?
Not that one. So yeah, watch out for a big breakout on gold at some future point in time, and it could be gearing up for that now. Silver is likewise looking positive in that it's broken its bearish trend line previously. It did break back below the short-term bullish trend, which is not something the bulls would have liked to see. But after the Federal Reserve decision, it did create this hammer candle or doji candle, and we've seen some follow through on Thursday. So this is
but it was tentative.
It was tentative.
I mean, there is like there is a chance of more downside.
Indeed.
Gotta say that while these patterns have been we marked a double bottom around 23 just at your invalidation level, which you previously highlighted a couple of weeks ago. Well, this is something to really serve as proof, first of all, that this level is significant.
Yeah.
And second of all, if we made 2 attempts to break it, why not make a third one and see what
Indeed, yeah.
happens?
That could come about if the jobs report is really strong today. But if you're bullish or if you're turning bullish on silver, maybe wait for the price of silver to break above this bull flag pattern or bearish channel, depending on your view.
Yeah.
Break above that with resistance coming in at around, call it 24, the figure. That level needs to break before we could potentially see a move towards 25, or even the 200-day moving average at 25.40.
Yeah.
Let's go back to the
Shall we
FX
move
markets.
over to currencies?
Yeah,
Yes.
let's look at the currency. So despite the dollar going up, the precious metals have been able to hold their own relatively well, which is the point I was going to make. Now the dollar index is coming up to these levels, Victor. What do you reckon? Break above or falls break?
Well, I I have no idea, but yeah, let's stick to be data dependent.
Yeah.
I would say that if we see a non-farm payrolls report that is above 600,000,
yeah,
we could hold a break above. So yeah, watch out for these numbers. Like we have been. We've become used to the non-farm payroll report being a non-event, and I
yeah,
feel like over the next several months, it's going to become like we are becoming more data dependent, really,
yeah,
as the Fed's tapering has started, and as they have openly discussed the issues. Like there was a very important change in the statement. I don't know if you have noticed it.
which was
Which was they said at the previous meeting they said inflation is transitory.
uh-huh.
At this meeting they said it's a very subtle change.
All right.
Inflation is expected to be transitory.
I noticed that. Yeah,
you only insert like one word and suddenly the sound of it
changes.
like the meaning of it, the sound of it doesn't change much, but the meaning does.
Yeah.
So the Fed is kind of backpedaling a little bit here and says, well, yeah, we actually thought it's transitory, but we're actually not that sure anymore that this is the case.
Yeah.
So
typical Fed for you, right? Always behind the curve.
Yeah. Always
Um,
behind the curve.
yeah.
And always hesitant to take bold steps. So
Indeed.
let's see.
Let's move on then from dollar index to a few currency pairs, and I think
Let's talk about the pound.
the pound, yeah, because the pound, obviously, the Bank of England, the Bank of England's new governor is
surprising the
becoming
markets yesterday. Yeah.
unreliable boyfriend 2.0. He's
Who's 1.0?
Mark Carney, the previous
Oh,
governor.
okay.
Yeah,
All
yeah.
right.
That's where they got the nickname from.
Okay.
Now under Bailey, he has been talking hawkish. He's been talking the talk, but he hasn't walked the walk. He was expected to encourage his MPC colleagues to hike interest rates, but didn't.
Yeah.
And the pound slumped as a result. Straightforward reaction. Support broke here at 136, and the bottom drop. Price went down, hit 135 initially, and now it's resumed lower. The next target is 134.40, which was this low here. What I'm expecting to see is that level to be taken out. And then what happens there is really important. If you get an immediate rejection here and we go back above the 135, which would thus create a hammer-like candle, right? If we get something like that in response to today's jobs report from the US, that could signal a reversal for the pound. This is what I'm looking out for. And if we don't get that, and if price shows shows heaviness or acceptance below these levels, then in that scenario, we could be seeing some deeper correction in the week ahead. So
Yeah,
right now I'm not
towards
touching it because it's already
132-ish or something
yeah
like that.
yeah. So right now I'm not really I don't really have too strong a view on it in the short-term outlook because it's gone down to it's already gone down quite a bit from yesterday because of the Bank of England decision.
Right.
So that's the level to watch at 134.12 is the level to watch. Let's see if it will create a false breakdown here, which would be bullish. If not, the bearish trend would continue. Euro dollar. Sorry, I was talking about the pound yen earlier. Let me just talk about pound yen and then we'll move on. Okay.
Sure.
This is the reason I was interested in the pound yen.
We're
From a
at a
technical.
very key level.
Yeah. The reason this level is important is because, if you look at previously, it was the top of a multi-week or multi-month even consolidation before prices broke out to the upside. That was on the expectations that the Bank of England would hike. Obviously, those expectations were not met yesterday and price dropped, but it's back at the point of origin of the breakout, and sentiment towards risk is strong with stock indices hitting record highs. So I reckon if the pound has any chance of a comeback, its best bet would be against the Japanese yen right here.
Yeah.
Yeah.
Okay.
So maybe what to wait for a hourly hammer candle or whatnot, maybe after the Fed, after the jobs report in the US, before potentially looking for a long trade.
There is a question from H.H. Hassan. Which markets are clearer to trade at the moment? Now, that's a difficult question.
It is because if you look at the major currencies, I reckon one particular market that might be clear is the Japanese yen on the short side.
All right. So you mean that if the report is pretty bad, betting a short dollar against the Japanese yen?
Well,
yeah. Well, betting short, which means going long on the Japanese yen.
That's if the data disappoints really badly. So maybe one way to get on board would be to kind of go with a stop order below a certain level, below this trend line somewhere, just ahead of the jobs data. If that comes out, if the jobs report comes out weaker, we could see some downside follow through. But I wouldn't want to short at
to
market
be caught on
because
the wrong
could
side.
be caught on the wrong side. Yeah. So that's why I would say this one, but maybe something to consider. If you're bullish on the dollar, let me just plug in the charger for my laptop because, as you may have seen, it could be dying any minute soon.
Yeah, it flagged you.
Yeah.
So what I wanted to talk about while we're discussing the yen is a longer term chart, which is the monthly chart, I feel.
Yeah.
You can
sorry, I
over.
haven't answered the H.H. Hassan's question completely. I'll come back to that, but let me share the monthly chart because you wanted to talk about the monthly chart. So here it is.
Yeah. So this could be a clear trade to answer H.H. Hassan's question, assuming that we finally break through this 114 area that has stopped the pair from breaking through. Like 114.50 is the line in the sand. Like we keep getting there and we keep getting rejected. A break above 1450 to me opens a really, really, really long-term move in the of depreciation of the Japanese yen.
Yeah, I agree.
So this is something to complement the pound Japanese yen that you mentioned. Like if we see a break in the dollar Japanese yen,
it's
we're
going to
most
affect all
likely
the
going to see other Japanese yen crosses getting impacted with accelerated selling of Japanese currency. So this could be a clearer trade.
And what is the most clear trade at the moment, regardless of the employment report? If that was your question, well, for me, it's the European indices, longer stocks. Indeed. Let's look at a few of them, okay? Because it's really important to highlight what's been happening. The FTSE has been one of my favorite ones, and FTSE is really not my favorite index by any means because it rarely moves. But technically, right now, it's been one of my favorite because it has come out of this 6-month consolidation period, bounced at prior resistance, and it's moving away from it. So that's your answer, European indices, the FTSE in particular. But look at the Spanish IBEX. Came out of this consolidation zone, broke out above the trend line, confirmed the breakout a few days ago, pulled back today to retest the broken area, and it's bounced from there. There's another one. Likewise, if you look at the German DAX index, it's just reached a new all-time high today. Obviously, the DAX is looking a little bit overextended, so maybe it's best to look at the FTSE or the IBEX if you're looking for long trades. So that's where the clearest trend is at the moment, European stock indices. I don't say US because US markets obviously look very overextended. Look at the NASDAQ 100. There's a risk it may come back down a little bit from here. But still, the dips have continued to be bought in the European indices, in US indices. The Dow here broke
the
above
dips
this
have
record.
been shallow and temporary.
Indeed. So look at the S&P 500. I mean, that's crazy. It's keep on going up and up and up and up. So risk is positive towards equities, and that is important if you trade currencies.
Looking at these risk assets, the trend in the Japanese yen is even more, surprising. Like, why hasn't it broken through these levels? And typically the Japanese yen depreciates every time we see risk assets like stocks rally significantly. So something's up. Let's see which market is correct.
Here's another interesting chart, guys. The CAD yen. Normally, I don't talk about the CAD yen on a non-farm payrolls day, but today I'm making an exception because if you look at the economic
Canadian
calendar,
non-farm payrolls as well.
Indeed. From Canada, we are not expecting a massive number for 42,000, but the Canadian Central Bank has been quite hawkish. And although oil prices fell quite sharply off their highs yesterday, they have risen to like $80 a barrel, 85 even previously, which is great news for Canada. So the Canadian dollar remains fundamentally supported, especially against currencies where the central bank is still dovish, including the Japanese yen. So this is an interesting pattern, retesting the broken level. If we see a hammer form here, could be a candidate to keep an eye on early next week. Right. I think time's up. Victor.
Do you guys have any other questions? Last call for questions. I think that's about it for this webinar. Thank you very much for joining us. We hope we have been useful to you in sharing our views of prospective moves in the market. We wish you good luck, and we're looking forward to speak again soon on our regular webinars, which are every Tuesday at 11:30 a.m. London time. Fawad is sharing Fawad, if you're talking something, just unmute yourself.
Yeah, no, I was talking to myself. Sorry, forgot to unmute myself. Yeah, then the next one is on the 9th. You can register by clicking on this button. You can get there by going to our website, go to market analysis, live webinars, and you land on this page, and you'll see all the upcoming webinars there. Thank you so much for joining us. Take care, guys. Bye bye. Be careful out there.
Bye bye.